It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of Bank Information. Take charge of your financial future with Your Personal Bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show, and I'll tell you what, we have to talk about a subject that's, not entirely pleasant, of course, but of course it's becoming increasingly important, and that topic happens to be inflation. Now, the reason I need to discuss inflation is, there's several reasons why I think it's important we start to discuss it. First of all, I want to start off with a couple of articles that I read very recently that I kind of tell the story, or part of the story at least. And one of those is fears of inflation hit highest levels on record. The Chase CEO warns very good chances here to stay. These articles, by the way, we're going to post these on our website, yourpersonalbank.com, so you can check it out, pass it on, whatever you'd like to do. But the thing is, like it says in this article, the fears of inflation are soaring to new highs as more and more experts are warning that it could become a major problem in the years ahead because of President Biden's massive spending. Now, it's kind of hard to put things in perspective in terms of how much the federal government has been spending for this past year or so. We're going to try to quantify it a little bit more, and it's eye-opening, okay? And like I said, like this article talks about, it says there's a very high likelihood that the inflation will not be temporary as the Biden administration has been trying to claim it to be. And the reason is like the Chase, J.P. Morgan Chase CEO states, he goes, inflation is one of those things it's like a lot of other things. It's a lot easier to prevent than cure. And he's got a good point. I mean, we've heard that statement, an ounce of prevention is better than a pound of cure. And it really is that way when you talk about inflation, because it's something that kind of builds and builds and builds on folks. And this is where it really kind of puts things in perspective. So if you haven't heard these numbers, it's going to be eye-opening. I'm going to tell you that right off the bat. It was for me. I had I keep pretty close attention to this stuff, obviously. And I feel like a pretty good handle on, the government spending and their economy and different things like that. But when I saw these numbers that the Chase CEO was sharing, I was shocked, or I was surprised. They were higher than I thought, even, frankly. And his point is, and this I thought was a very good point. He said, look, total wages and salaries coming into people were about 20 to 30 billion a month lower because of the COVID shutdown. So, in other words, wages and such like that, what people were earning, what they then spend money on, again, about 20 to 30 billion dollars a month below normal. But he says, but when we put in a stimulus that's putting into the economy more than $200 billion a month, that's when you take a hole and you overfill it and you're likely to have problems. He's got a very good point, because what he's saying is, look, our federal government and our stimulus spending is spending upwards of 10 times the amount of money that people normally earn, or what's normally earned and put into the economy. And when you have that many dollars chasing the goods and services, the dollars are going to, the prices of those goods and services are going to go up. And that's the basic definition of inflation. More people, more dollars. Also, each dollar is going to be worth less. It's another way to look at it. Your buying power reduces. So like the Chase CEO stated in this article, he said, look, we've been actually stockpiling more and more cash, waiting for opportunities to invest at higher rates. See, here's the thing you need to understand about banks. And if you've listened to the show at all, I'm on the board of a bank in the process of trying to open an FDIC insured bank. And the thing is, what's good for the banks, folks, is not necessarily good for the general public or the economy, okay? In other words, if they're as the Chase CEO states, if they're investing at higher rates, well, how do banks primarily make their money? And the answer is through issuing loans, loaning money to people, right? That's our primary source of income and profit and all that kind of good stuff. So here's the thing. If they're loaning at higher rates, that means people are paying more interest, right? Is that good or bad typically for folks? Certainly for the borrower, it's bad, because then you're of course paying more to borrow those monies, right? Business would have to pay more. Individuals, all across the board, if that incurs. And the thing is to understand about that is, typically speaking, when you talk about higher interest rates to access and use money, money is the fuel for business, right? And businesses fuel the stock market, for example, the prices of stocks for the most part. Well, if it costs more to access monies to grow or expand a business, for example, then the cost of doing business goes up, which means profits tend to go down, which means the stock price tends to go down. That's why, in a nutshell, very simply, why higher interest, higher inflation is, generally speaking, bad for business and bad for the stock market, for example. So again, a lot of people are getting very concerned about this, and frankly, rightly so. All right. The other thing, we're going to talk about some solutions. I'm going to go further on this. We're going to talk about some solutions in a bit. So I do want you to stay tuned. And always, you can listen to our previously recorded shows on yourpersonalbank.com. Go there anytime. But another article here that I thought was very eye-opening is the Fed dramatically hikes inflation projections in much-awaited meeting and will not taper stimulus. Now, this is a twofold whammy, so to speak, in terms of inflation and stoking inflation concerns. And first of all, the Federal Reserve increased their estimates of inflation for 2021 an entire point since March. So the bottom line is they are now predicting a 3.4% inflation rate for 2021. Now, they were predicting 2.4. So an entire point, by the way. This may not sound all that bad. But for the Federal Reserve to change a projection an entire point, that's a really big deal for the Fed, okay? The other thing to understand about a 3.4% projected inflation rate by the Federal Reserve is how they count inflation does not include energy or food. Now, by the way, for folks, for the average individual, about half of your expenses, that takes up about half of the individual's expenses on how they count it. So in other words, most economists are stating, look, if the Fed Reserve says 3.4, you can roughly double that. So in other words, most economists are now projecting real inflation for the average individual, for the average American, for 2021, it's going to be around the 5 to 6% range. And there's some other, couple other things that are backing that up. The Consumer Price Index, for example, that's the measure of prices of household goods, is up 5% already year to date from last year. Okay. Now, granted, we're going off of last year was a rough year. That's what some people will say. Well, last year was a rough year, and inflation's been really low for the past decade. That is true, but a 5% increase is still significant. And then if you're looking at the Producer Price Index, and that's what, as a metric that tracks business purchasing costs, that actually has increased 6.6%. So again, if the cost of doing business, the cost of purchasing items is increasing at a 5 to 6% rate year to year, or at least in the next year or so, or 2 or 3, that is significant inflation. That will eat into people's buying power. That will have significant impact on our economy and everything else, the markets and all that kind of stuff. So this is huge. This is really big. Now, all this stuff hasn't come down the pike, so to speak, yet, but it's one of those things you have to be prepared, and it increasingly looks likely that it's coming down the pike. And here's the third and last thing I want to share that's really, I'm going to say, in my opinion, extremely disappointing that the Fed has also decided to continue promoting the near zero interest rate and purchase treasury bonds. What does that mean? Well, they're saying inflation, we project it to be higher, quite a bit higher than we originally thought, but we're going to still keep this extremely low interest rate environment, which enhances the possibility of inflation by keeping things too low, far too low for far too long, therefore creating a bigger and bigger bubble, right? And the second thing, even more worse, is purchasing treasury bonds, which basically means printing money, okay, folks? That's the bottom line. So by printing more dollars, you're again adding fuel to the fire is what you're doing. Look, like the Chase CEO said, there's already too many dollars going into the system, upwards of tenfold more than what's normal, which is way too much. And then the Fed is just piling on. It's like you have a bonfire, And this fire is starting to get out of control. All right, you're starting to lose control of this fire. And if it does get out of control, it's going to burn everything around it. All right. And what does the Fed do? How do they respond to it? They're basically throwing gas on it. So it's going to increase the size of the fire, increase the bubble, and very likely, and cause more problems, more inflation. And like the Chase CEO says, can hurt a lot of people. All right. So I'm not saying this to scare anyone. I'm not saying this to be negative or anything like that in any way. What I am doing, though, is putting out a warning that this is something that you should be aware of. This is something you should be concerned about, and you should be addressing when it comes to your money. Folks, it's time to take a serious look at future inflation and how that's going to affect you, how it's going to affect your money, your portfolio, your retirement, your investments, all that stuff. I've talked about this many, many times. And I've talked about what do you do when you start facing a higher inflation environment? See, it's something we haven't really had to deal with in over a decade. And, human nature, we get comfy, we get used to certain things, and we get in that comfort zone, if you know what I'm saying. And the problem is going to happen is a lot of people are going to be taken by surprise by all this. If they were paying just a little bit of attention, they wouldn't have been. They shouldn't be surprised, but they're going to, because you get used to a certain way. You know what I mean? And it's been this low interest rate environment, low inflation, extremely low, like historical lows. I've even heard some folks sharing that we're in the lowest interest rate environment since 1787. Now, that's pretty significant because that's the history of our country, right? So there's no question we've been in an extraordinarily historical, generational, low interest rate environment for quite a long time, something along the lines of about 12 years. People get comfortable and cozy with that. And it's looking increasingly likely like that's going to change, and it's going to change significantly. So you need to be aware, you need to be prepared, and you need to plan accordingly. So I'm going to encourage you to stay tuned into the next segment, because I'm going to go into some of the solutions and some of the things that you need to start considering and looking into for an environment where we're dealing with a higher inflation rate, or higher inflation rates that we've been dealing with for the last decade plus. So stay tuned on this. Don't miss it. This is huge. I'm sending out the warning, or ringing the warning bell, okay? We did it with the COVID, but prior to the COVID shutdowns, and I'm doing it again with inflation, so don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. Today we're talking about inflation, and the reason is it's becoming increasingly concerning for a lot of people. There are a lot of experts, economists that are starting to ring the bell, the warning bell, if you will, about beware of future inflation rates over the next several years. Again, like one of the Chase CEO, one of the articles I shared with already in the first segment stated, this is something that's a lot easier to prevent than fix. It's easy. It's like anything, an ounce of prevention is better than a pound of cure. So he kind of pointed that out. He's right. The other thing he talked about was that the stimulus that's been going out this past year is upwards of 10 times of what people normally earn. So there's that much more going into the system. And again, that many more dollars going into the system just causes the prices of things to go up and the value of each dollar to go down. So your dollars don't go as far. All right. And even the Federal Reserve has come out just recently, increasing inflation's estimates and projections to 3.4% was where they're at now, which does not include food or energy, which for the average individual is about half of what the impact is in the average American. So real inflation, most economists are stating, for the average American is going to be at somewhere around 5-6% projected for 2021, and likely will continue beyond that. The last article I want to share with you, and all of these, by the way, will be on yourpersonalbank.com, so you can check them out, share them with others, whatever, is and this was the one that I find personally very egregious. And this one article is, families can get 6 figures of worth of government handouts in 19 states. All of them happen to be currently Democratic states. In other words, what they're saying, on an annualized basis, a family of 2 unemployed parents and 2 children can receive a maximum benefit package in Massachusetts of over $147,000. Folks, that's a lot more than the average person earns, an average household earns in a year. Even in Massachusetts, there's many other states involved with this, Washington, Jersey, Minnesota, and others, that are well over $100,000. Like they said, there's something like, 19 of them, actually, where the family can earn over $100,000 for basically being unemployed. And that's a combination of, say, rent assistance and school lunch programs, food stamps, you name it. You put it all together, and they're bringing in over $100,000 a year. Now, you wonder why some people have chosen not to work. That there just answers it right there. In fact, the statistics show that many of those states, nearly all of those states, their unemployment rates in those states are well above the national average of about 6.2% right now. Well above. And so, again, the average benefits in those states actually exceed the median household income. I mean, I don't blame the people. Look, if the government is going to pay you, or somebody's going to pay you not to work as much or more than you would have gotten working, it's kind of hard to justify going to work, isn't it? And, that's just basic human nature. So I don't really particularly blame those people. But the thing is, I've stated this before, and as a fiscal conservative, this is frustrating as you all get out. That money isn't free. That money comes from somewhere. And this is where I would personally have a hard time accepting those monies, because I understand that. Now, whether the folks receiving the money understand that or not, I can't say. I would venture to say most really don't, because fiscal literacy, financial literacy is so pathetic in America today. It just really is. And I'm talking about, I've had conferences where I've done workshops and conferences educating on financial literacy for years. One comes to mind where I was doing that with a group of college professors, all of them economics professors, by the way. This was just a few years ago. Several had written books on economics. Everyone in the room was a PhD or higher in education. And I was sharing with them the personal bank concept, like we talk about all the time. Establishing a high cash value policy, accessing funds from the bank line of credit, creating the positive arbitrage, making your money go further. And folks, in an inflation environment, that's going to become more important. I'll touch on that further. But I was sharing all these ideas, all the thoughts that I share on the radio with you each week. And one of the leading professors of the group, he stood up and he said, what we were doing was we were proposing, there's a college accredited financial literacy course. It was being taught in one of the colleges, and we were looking to expand it into several others. That's why the professors were there. And one of the leading professors in the room said, you keep talking about doing this and educating this for the college students. Folks, we need this information. I need this information. And basically everyone in the room nodded their head in agreement. Folks, financial literacy is not common in America. I mean, truly understanding money and how it operates and how to get your money to work for you and work for you more efficiently is extremely rare. And I'm talking about folks that are even very educated, very successful, very intelligent. Okay? It's not about intelligence or success or any of those things. And I know I'm going to say something here that'll be sacrilegious to somebody, but to basically put money into something and let somebody else handle it all the time and not really pay attention that's counting on someone else. Okay, if you have limited knowledge and experience and you want to count on somebody else that you trust, that's fine. That's probably better, frankly, that you have somebody. But I think a level of financial literacy should be taught, should be educated, needs to be learned. And unfortunately, most people I deal with don't. I mean, simple terms like I deal with all the time. What is positive arbitrage? I mean, positive arbitrage for some of you that are listening is a basic 101. I get it, okay? But it's amazing to me the number of people that really fully don't understand positive arbitrage. And folks, all it is Sounds like this big, complicated term. It's not. Positive arbitrage, is simply put, is you're earning more on the money than you're getting charged to use it, and you're keeping the difference. And your personal bank is a perfect example of where we set up policies. We earn 5.75 to 6% dividends, and then we access it from bank lines of credit, usually at 3 and 3.25% interest range. And when you access those funds, if you earn 5.75 to 6% dividends, you're getting charged 3 to 3.25% interest. What's your money doing? Just about everybody gets that answer correct. You're making money. You keep the difference, right? And that's what your personal bank does. But the key to that, of course, is, again, it's on money you spent. In other words, that positive arbitrage, if you leave the money in the policy and earn the dividends, the money's going to grow, right? Everybody understands that. But if you access it and use it, you can still earn interest on it, even though you spent the dollars. Again, why is this so important? Well, if inflation does indeed increase because, gosh, our government is paying families upwards of $147,000 a year in benefits, okay, to not work, what do you think the value of the dollar is going to be? What do you think the cost and price of goods and services are going to become? How is that going to upend everything or change what was the norm previously? In other words, whatever money you have, you need it to work more for you. You need to work for you more than once, not just invest it and hope it goes up. You need it to work twice. What do I mean? Pick up some positive arbitrage and then invest the money. Get it to work double duty because it's just going to be worth less in the future. Okay? And I've talked to a number of people that are sitting on a lot of cash because, well, they're not sure where to put their money. They're concerned about where the markets are. They're concerned about taxes or starting to get concerned about inflation. But if you're sitting on cash, you're just losing money. Stay tuned to the next segment. I'm going to talk about further how to solve that and really what to do. So don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. Today we're talking about inflation. I referred to 3 articles so far, which we'll post on our website, yourpersonalbank.com, so that you can check them out, pass them on to others. But its first one's by Chase CEO, talking about being concerned about inflation, higher inflation going forward. Their bank is basically counting on it. And like he said, it's easy. Inflation is easier to prevent than cure. And as he pointed out, that the federal government, the reason they're concerned about inflation is the federal government has been spending and contribute stimulus into the economy upwards of 10 times per month more money than what people normally contribute to the economy while they're working. With that kind of money flowing into the system, it just causes the price of goods and services to go up and the value of the dollar to go down. And that's the definition of inflation. I also referred to a second article talking about, the Federal Reserve. Federal Reserve increasing inflation projections. Without food or energy, they're projecting 3.4% inflation for 2021. Most economists state true inflation numbers for the average American will be more like 5 to 6%. And then the third article talking about how a family of 4, husband and wife, 2 kids, can receive up to $147,000 in total federal government benefits today if they're unemployed. And that's unemployment, rent assistance, food stamps, the whole shooting match. In fact, in 19 states, a family of 4 can receive over $100,000 a year. And you wonder why folks aren't working. I mean, that's higher than the median income in those 19 states, basically, for the most part. So if you can earn more and not working, than you can while working, it stands a reason why a lot of people choose not to work. I can't really put the blame on those people. Now, if that's what they want out of life, to depend on somebody else basically to pay their bills for them, I think psychologically and emotionally that's hugely damaging to a human being. We're not designed that way. We're not built that way. But there's a lot of people out there today that don't have the emotional maturity to realize that. And I don't know how else to put it. And it's sad. It's really sad to see. I feel bad for those people. But that's what's happening, and our government is, well, enabling those people. I mean, that's probably a good way to put it. And, when you talk about enabling people too much, where in essence you just give them everything, people tend to not grow, not learn, not improve. In fact, they tend to decline emotionally, physically, all of those things. I mean, there's a lot of issues around, say, Indian reservations, for example, but a lot of things were given to them to enable that to happen. And it's really sad to see. And I've been firsthand seen it. My own mom was a school teacher and taught on several Indian reservations. And I met with her, met some of her students, and she told me about, it was just sad, just incredibly sad stories, that the lack of confidence that these students had in themselves, the lack of vision, the lack of anything for something better, a better life. Okay. And that's the trap that many of these people are falling into. And it's sad. I don't know. There's no two ways about it. But from a money standpoint, I got off track there a bit, but I just find it really discouraging when you see that happen to people. I think it's a type of abuse, in my opinion. Okay. I just believe it's a type of abuse. You're abusing those people by enabling them rather than actually helping them improve their lives and have a better life, instead of just making them dependent, right? It's that dependent society versus the opportunity society that I've talked about so many times. The thing is, all this money, all these things that are happening are creating a situation where inflation is already increasing. The Federal Reserve has stated that and projecting it to increase higher. And the Federal Reserve currently is still keeping interest rates extremely low and continuing to print money. So they're literally throwing gas on the fire. They're doing nothing to stop it, but making it just adding to the problem, which will most likely add to the bubble and add to the issue. What do? Well, in a higher interest rate environment, inflationary environment, there's a couple of directions to go that historically have been shown to work. And one is tangible assets. And one of the most common tangible assets most people are familiar with would be something like real estate, because the value of the property, the real estate, will tend to go up in a higher interest rate environment or an inflationary environment. Now, when I share that with a lot of folks, of course, they understand, they agree. The problem is the cost of real estate is out of reach for many people today. So what else can you do? Well, you focus on interest rate sensitive investments. Since we're out of time, I'm going to have to talk to you about that in the next segment. So I'm really going to encourage you to stay tuned. Don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. Today we're talking about inflation concerns. They are definitely on the rise for valid and significant reasons. I've talked about that in the previous segments, referred to several articles, including the Federal Reserve, talking about higher inflation projections. If you missed it, I encourage you to go to yourpersonalbank.com, our website, check out the articles, pass them on to others. You can go to any of the previously recorded shows, by the way, anytime you like. In fact, I just got to say this, we've had several in the last several weeks, some outstanding interviews with several clients and such that I've worked with over the last several years. And, Gary McDermott, John Wartenberg, John Troms. I mean, those are some outstanding folks. If you didn't hear those, check them out. I really encourage you to do so. But today, again, we're talking about inflation because, well, with all our federal government spending and the stimulus and the Federal Reserve continuing to print more and more dollars, that means the prices of goods and services are on the rise. That's already happening. That's a fact. They're projected to increase even further and most likely for the next several years. Okay? This isn't transitory like we keep hearing politically. Most likely. Most economic and money people understand this it doesn't go away that quickly. Those dollars got to go somewhere. They got to flow somewhere, and they're going to chase goods and services, which means those goods and services are going to cost more. And we're talking about things like food, clothing, housing. That's already happening as we speak. And when you're paying people with not to work and food stamps and school breakfast and lunch programs and rental assistance and everything else, and in 19 states you're paying a family of four over $100,000 a year in total government benefits. That's what they can receive, folks. That was eye-opening to me. That's higher than the median income of those states. You're paying people more to stay home than to work. That's going to also continue to increase the economic challenges and inflation. Okay? So what do? As I've stated before, tangible assets and interest rate sensitive assets. Tangible assets most predominantly are things like real estate, things that increase in value over time, especially when you talk about more dollars chasing those items. There's other items that can increase in value, historically have done so, and that would be like things like collectibles, classic cars, for example. Things like that have traditionally had value. Many other things like that. I think it'd be pretty obvious anyone who's paying any attention that guns and ammo are going to be worth more in the future, especially if the government continues to tackle or challenge Second Amendment rights, things like that, and restrict the gun ownership. Whether you believe in it or not, or agree with it or not, you can't argue the fact that they'll have more value in the future. So tangible items like that, right? Being practical here, right? There's a lot of talk about precious metals, and let me just touch on that one for a minute. I'm not as big a fan of precious metals personally as a lot of folks are, because I look at the history of what's actually happened, okay? Recently, if we want to look at recent history, March of 2020, when the COVID shutdown started, the markets dropped about 30% in 30 days, roughly. And that's a natural time when you would think that gold, for example, would increase in value. Go back and look at the charts, folks. It didn't. Why? There's a lot of reasons behind it, but most people think that the main reason behind it is approximately 80% of the gold reserves are held by the central banks of the world. In other words, they control the commodity. Basically, they control the price. And they decided they didn't really want the price to go down, so they did what they needed to do to keep the price down. You know what I'm trying to say? They can buy and sell and do those kinds of things. And if you control most of the supply, you can do that. All right. So I'm not a big fan of the central banks in terms of trusting what they do. I mean, right now, I totally disagree what they're doing about continuing to print money, even though at the same time they're projecting higher inflation. That's just, to me, ludicrous, but that's what they're doing. So I don't trust their judgment. I don't think they're as smart as they think they're. And I'm on a bank board, folks. I don't think they're nearly as smart as they try to portray themselves to be. I don't trust their judgment. Okay? It's kind of that simple. So that's why the whole precious metal idea isn't as appealing to me. And let me give you another example. The Great Depression. This one's often referred to. A lot of people don't know this even. This is history that so few people know. It's amazing to me how many people I share that during the Great Depression, the Roosevelt administration they made gold illegal. Folks, gold, obviously with the Great Depression became a great wealth asset, and people were, using it as that, obviously, for obvious reasons. And because the government really couldn't control it, they decided to set the price, and they would buy your gold, and then after a certain date, if you didn't sell it to them, it became illegal. My point is, folks, what would stop them from doing something like that in the future? Folks, if they can't control something, what would stop them from, say, banning cryptocurrency? Okay? In fact, the country of Turkey has already done that, along with several others, just in the last few months. So I'm not saying that's going to happen, but what I'm saying is I would not rely on it. Wouldn't count on it, because our federal government, which has been very active, overactive, frankly, has taken steps historically and more recently to control those kinds of things. So you got to keep that in mind. So again, the tangible assets are, in my opinion, are more like the things like real estate or collectibles or things like that. What you got to ask yourself a question is, if you really are concerned, and I'm getting more and more of this, people concerned about currency, devaluation, maybe, even worse, economic crisis, okay? People are getting scared, okay? They're concerned. Change scares people. I get it. And I'm not sitting here trying to put fear into anyone. I'm just trying to educate and help people go into this with their eyes open. What you got to do is ask yourself a simple question. If the worst happens, if the things happen that you think may happen, what are the things that are going to be of value, okay, to people? That's the question you have to answer. And you got to ask yourself a question. Is yellow gold going to be something somebody wants? Or are they going to want food, shelter, and protection, like guns and ammo to protect their food and their shelter? You see where I'm coming from? I'm just being practical here, okay? Whether you agree with that philosophy or not, I just want you to understand, when you know what hits the fan, or you're up a creek without a paddle, right? When it comes down to it, what's going to be of value to people, right? Now, do I believe it's going to get that bad? Personally, I do not. And I hope for everyone's sake it doesn't get anywhere close to being that bad. But I do believe inflation is going to become a factor, and probably a significant factor, over the next several years. And one of the best things to do there is invest in an interest-sensitive asset. What are those? Well, a lot of your bank assets or CDs and things like that are interest rate sensitive. Bonds, anything dividend paying is. Okay, your personal bank is a dividend paying type of account. See, historically, if you look at that today, you look at CD rates and stuff, you can tell in the bank, go to any bank, and they're extremely low. But if you go back just a decade or so ago, I remember not all that long ago, you could get a 5% CD. It wasn't uncommon. In fact, that was common. All right? In fact, the dividends paid by personal bank policies, we're talking early 2000s, folks, early mid-2000s even. Dividends were in the 7-8% range. That was the norm. Today, they're in the 5.75 to 6% range, which is much, much higher than most other dividend-paying assets. One of the reasons why I'm such a fan of your personal bank, because they've been able to hold the line, so to speak, and still pay a decent dividend, even in an historically, generationally low interest rate environment. There's the argument I had that with two people today. Not the argument, but looking at, should I go with an index product, IULs, things like that, versus a whole life or dividend type product. Well, you have to think about this a minute. Where is the S&P 500 index if you're going to invest in something like that? At or near all-time highs. Could it go higher from here? Certainly. Could it go lower? Absolutely. Where are dividend rates today? At or near all-time lows. Have you ever heard the adage, buy low, sell high? In other words, when do you want to buy in? At or near all-time highs, or at or near all-time lows? And what's the future look like? If interest rates go up, if inflation goes up, dividends are going to historically have gone up. Stocks have historically, the markets have historically gone down. So you see my point. I'm not saying not to invest in an index-related asset, annuity, IUL, whatever. But what I'm saying is look at where we are in the cycle and look at the risk. Does it make more sense to buy low or buy high? You see what I'm saying? And then I guess the last part of it that is so important is the positive arbitrage that your personal bank offers that's unique to anything else I've ever seen or I'm aware of. And again, it's the ability to earn dividends or interest higher than what you're getting charged when you access the funds and use it. In fact, I met with two different real estate investors. One understood the concept and the other missed it. One was like, I already had one in place. They've been funding it for some time and realized they could put a whole lot more in because we had structured it that way to give them that ability. And he said, wait a minute. I've got some extra money here. I could put it in my personal bank policy, increase my line considerably as a result, my line of credit, and then access those funds and do my investing that I'm doing and pick up 2.5% arbitrage. I said, exactly. See, if you don't do that, you're just walking away from money, aren't you? You're walking away from interest you could have been earning. The second person I met with, he was looking at funding this, and he's doing that, which is great, but he also was looking at taking some money and buying an investment property. And I said to him, certainly you can invest in the property, take those dollars, invest in the property, or why not fund it in this policy? He was already approved for all these numbers. That was what was amazing. And I said, why not put it in here, get 575 dividends? In his case, that was the situation. It made the most sense for him. Then access those funds and get charged 3.25% interest. Therefore, he was keeping the difference, right? 2.5% positive arbitrage, and take those dollars and invest in that property. And he had the funds to do it. There was enough money to do all that. Because when are those funds available? Basically day one. I said we can all put all this together in the next, week or two logistically, but in a couple of weeks you could have your funds available and pick up the 2.5%. He got hung up on the thought that I would owe interest to the bank. And I said, yes, you would owe interest to the bank, but by the way, because he's using it for business purpose, that interest could also be a tax deduction. So now his 2.5% positive arbitrage is even greater. It's even better. But he still got hung up on owing interest to the bank. And I said, think about this a minute. When you access the funds, do you access them from the insurance company or the bank? And of course, the answer is the bank. Therefore, the funds are still in the policy, earning, in his case, 575 dividends. If he if he paid the interest, he'd get the deduction. The amount he owed would stay the same, right? So his amount owed would not increase, yet the funds in the policy would continue to increase, compound at 575. If you're getting charged 3.25 and you're earning 575, what's your money doing? It's still growing. And he could take that money and invest in that property and make whatever profits he was going to make. So I basically made a statement. Do you want to earn positive arbitrage or not? Now, both of these people were very intelligent, successful business people. That wasn't the issue. He just didn't grasp the idea that he could pick up extra money and get his money to work for him twice. The one did, one didn't. And that's the crux of the situation that I run into on a daily basis with people. By educating them and helping them learn how to make their money work for them more than once, they're going to have more money. You will have more money. Your money will go farther, and when inflation affects it and starts eating away at the buying power, it'll help offset that. As always, stay tuned to the Your Personal Bank Show and contact me at yourpersonalbank.com for more information.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.